Hello, hi everyone. A very good morning. How are all of you doing today? Welcome back to another beautiful masterclass that we have lined up for all of you. Good morning, Kojum, Tyagarajan, Dharmu, Mayur. Hi, Manoj, Vinod, Rahul, Nand Kumar, Ankit, Karan, Maria. Hello, Ignatius. Welcome back. Hi, Kishore, Gopal, Maria again, Prakash, Manish, Amir. So many of you on the call. Wow, I mean, it's really interesting to see so many people in my English session today. Thank you so much for joining in, guys. We are just going to wait for another minute or so before we get started because we're just waiting for some audience to join in. But thank you so much. I see many familiar faces as well. Hi, Shashikant, Shiv Prasad. So just quickly tell me how many of you are attending my masterclass for the first time today? So for how many of you this is the first masterclass? If you could just put a yes on the comments, I would know. Hello, Surendra, Nitin, Animesh. Hi, hi, Sangeeta. Hi, Sakil, Shivam. How are all of you doing today? So just put a yes if this is the first masterclass that all of you are attending. And just a quick question, guys: Am I visible? Am I audible? If there's any technical issue, do let me know. I mean, if you guys can't hear me, can't see me, just let me know. Okay, Ankit, this is your first masterclass. Welcome. Okay, hi Saurav. Hi Ilyas Ahmed. Okay, thank you. Yes, okay, first time poet Urdu. I don't know your name, but okay, welcome, welcome. Rajkumar Lodhi. Hello, yes. Shruti, Arun. Okay, great. Hello, Narsiman sir. Welcome back to my masterclass again. Yes, thank you, Narsiman sir. Okay, good to know. Okay, and then we have Dhananjay. Okay, hi everyone. So good to have so many of you on my masterclass today. I'm a little overwhelmed. I have so many people today. Generally we have a little less audience for the English one, and we have not slightly, we have a much bigger audience for the Hindi session. So good to see that I have so many people for the English session today. So thank you so much for joining in. I think let's get started. Today we are going to obviously discuss a very, very interesting topic. We're going to talk about how to deal with market crash, right? And I'm sure a lot of you would be having this question. A lot of you would be wondering, if when is the right time to invest? How should I go about investing? But I do believe that sometimes it's always good to go back in the past and see what actions were taken, see what happened in the past, and is there any learnings from the past that we can implement in our future strategies. So today, that's what I'm going to be discussing about. So today, we're going to talk about some past market crashes. What happened to the market at that particular point in time? What were the actions taken by the government, and all of that? And you, as an investor, what could you have done, to make sure that your portfolio didn't fall as much, during recession, and in the future, how you can manage it better as well. Okay. So that is what we're going to be learning today. And so I'll quickly introduce myself for those of you who are joining for the first time. I'm Namrata, and we've been working with Groww for many years now. And, we create a lot of content for Groww where Masterclass is one such, one such form or format where, we try to deep dive into a particular topic, and we try to give you all the details about that particular topic, right? So we've done multiple master classes in the last 7-8 months. Every Sunday I do this for all of you, where we've spoken about different aspects about equity markets, about debt markets, mutual funds, stocks, behavioral aspects, asset allocation, you name it, and we've done it for you guys, right? And so today we've come up with a different topic, which will hopefully help you understand, how to deal with the market crashes that we have available. So I'm just going to quickly share my screen with all of you. Yes, okay. So I hope my screen is visible. Yes, okay, perfect. So let's get started. So I'm going to start with showing you a very interesting quote. So I'm a part of a lot of social media platforms, and a lot of these investment-related forums on different social media platforms where there are a lot of questions which people post, right? And investment-related questions. So there was this guy who said that I started investing in mutual funds last year, with 15,000 rupees a month, and all mutual funds are getting down because of the market crash. Not sure how far it's going to go down, and should I withdraw all my amount, right? So this was a query that came on social media, and I know how to deal with a scenario like this, right? I'm sure a lot of us do. I had just started my career in 2007, 2008 when the market crash happened. That's the time I got into the financial services industry. And I remember back then, when the market crash happened, a lot of people said that a lot of people actually took out their money during the market crash. A lot of people said that, this is, we don't know for how long this is going to go on, and I think we should take out the money. So I anticipated answers similar to this. So I'm generally a silent observer on these platforms because I don't believe in, you know, I don't believe that these platforms you should. I generally don't give too many answers. I just observe what people are giving as answers. So in this particular session, in this particular for this particular conversation, most of the people, there were 103 comments, and all 103 comments said that you should stay invested, you should not take out your money, you should stay invested for long term, and and the likes. And I just realized that there's such a big paradigm shift in terms of the mentality of individuals, in terms of their investments in the last 10, 12 years. Where 2008 market crash, a lot of people took out their money. In this market crash, people are still, they're like, I think you should hold on to it. So there's this huge difference in terms of mindset that we see in the last few years, which is pretty cool, because you have, that means the investors are becoming more conscious, becoming more engaged in terms of how they should handle their investments. Okay, by the way, for those of you who are talking about language, so this particular session is going to happen in Hindi as well at 12:30. I'm going to take the same session in Hindi at 12:30. This session is for my English audience. Okay, so for those of you who want to attend this session in Hindi, please feel free to join at 12:30. And for those of you who want to listen to me in English, please stay on. Okay, so now, like I said, there's a huge paradigm shift in terms of mindset. So what I'm going to do is I'm going to start off showing you a graph. I know it's not like the best way to start a particular session, but I do believe that sometimes it is okay when you're trying to put across a particular point. So look at this particular graph that you see on the screen. So BSE Sensex, Auto BSE 500, these are the three that you see. These are basically the returns or the CAGR from 2006 to 2020, which is almost a 15-year time frame that we're looking at. As you can see, so gaming boys, like I said, your Hindi session is going to happen at 12:30. So if you want to hear me in Hindi, please join back at 12:30. Okay, and I'm not going to repeat that again. The same session is going to happen at 12:30 in Hindi. This is going to be in English. So for those of you who want to listen to me in English, please stay on. For Hindi, please join at 12:30. Okay. So what I'm trying to say is that if you look at these seven sectors, which is consumer durables, FMCG, banking, healthcare, finance, IT, and energy, these are the seven sectors that have outperformed the index in these 15 years. So had you invested in these sectors, right, specifically, in the 7 years, they would have outperformed the index by a reasonably good margin. Yeah. Similarly, if you look at the underperformance, so we also have different sectors. So for example, here you have Sensex and you have 500, BSE 500. Similarly, if you see all these sectors, especially the last four, which is utilities, metal, power, telecom, these are the sectors that have given returns which are lower than your savings account returns. Correct? So now, had we stayed invested for the long term in these last four sectors, right? Utilities, metal, power, telecom, you probably would have lost out, or they would have been the wealth destroyers for you guys. So then the question is, then is it advisable to stay for long term in equity in general? Like, does it apply to every sector, every stock? Obviously not, right? Just because we say that equity investing is for long term, it doesn't mean that every sector and every stock is going to perform well in the long term, right? There are certain sectors, all sectors perform based on different market cycles. So based on the economic cycle or the business cycle that an economy is in at a particular point in time, you'll have different sectors performing. Okay, and that is what that you guys need to understand, right? That not all sectors perform the same at all points in time. So today's session is really an effort, to learn from the previous market crashes, but at the same time understand how sectors have behaved and what are some of the things that we should keep in mind as investors. Okay, so now I'm going to start off by showing you the different economic cycles. And yeah, so there's this beautiful quote that I read, and I thought I'll share it with all of you. It's by George Santana. Those who do not remember the past are condemned to repeat it, right? Which means our past is something that is going to help us in defining our future as well. So sometimes it is okay to look at the past to really look at what our future is going to be like. Yeah. So, like I said, let's start off with understanding the different economic cycles. And I'm just going to expand the screen for all of you to see. Now, as you can see, any economy or any economy goes through four different economic cycles or business cycles, as we call it. So, first is your expansionary business cycle. Now, that's the time when economy is experiencing strong growth. Okay, so that's the time when economy is experiencing strong growth. The interest rates overall, in general, will be lower, but at this particular cycle, part of the cycle, the interest rates will start to increase. Okay, as the expansion matures. Overall, the production levels increase in terms of manufacturing, and the inflation rates begin to rise at the expansion phase. So, in the expansion phase, you will see like good economic growth happening at that particular point in time. Then we have the next cycle, which is the peak. This is a time when peak is when the growth of an economy reaches a plateau, or it's like at the maximum rate, and higher inflation, which needs to be corrected. So inflation at this time is generally on the higher side, that needs to be corrected. Then we have contraction. So contraction is basically the time when the economy slows down. So this is a time when, this is a time when the economy is slowing down and the businesses start to lose profits, and that leads to downsizing, laying off of employees, unemployment rate rises, inflation tapers off, and this is a cycle that continues till the trough. And trough, which is the last part of the cycle, is basically the low point in the economy. This is the time from where the economy re-enters into the expansionary phase. Now, if you look at any of these cycles, this is how the business cycles perform. So like I always say, anything that goes down has to come up, anything that is up has to go down, right? So you will see this economic cycle happening. When the economy is at a trough, then the expansionary phase has to start after that. And this is what we as investors should be able to understand and should be able to gauge, that at this particular point in time, in which part of the economic cycle are we in. Okay, because that is going to define in terms of how we are going to invest our money. Clear? So as you always say, markets always look ahead. Markets don't go in tandem. Markets always look ahead. So markets always perform based on your anticipation, right? So markets are always moving in terms of anticipation, that if this is going to happen, then markets have already performed, for example, right? Markets don't wait for the GDP to go down for it to crash. It runs on anticipation, right? So which is why you will always see that the markets would have already corrected if there's a downward economic trend expected, right? So which is why what we need to look at is, so if you look at this particular cycle, this particular slide, for example, now if you look at expansionary phase here, when it starts going down, you'll reach the trough, right? But in between, you will have your other phases as well. So we've reached the peak, this is the recession, and this is the trough. So basically, this is your expansionary phase, this is your peak, this is when we are coming down, and this is a trough. So at this point in time, someone asked me which phase of the economy we are in. Right now, we are in the expansionary phase. So right now, we are in the phase where we are getting into or slightly into the expansionary phase. Okay. So moving on, now let's understand this. So I know now this is going to look a little confusing, and let me just expand the screen for you. And this is a super, super interesting slide. So first, what I'm going to start off with is I'm going to tell you about the different market crashes that we have experienced in the last few years. I will mainly talk in detail about the market crashes that we've experienced in the recent past, not very old ones, but I still want to show you this chart because this is like really interesting. Okay, the light blue segments, that these segments, right, the ones on top are basically the bull market time. Okay, and the lower segment is basically the bear market time. So these are the times when recession has happened. So here, if you see, basically this is your 1929 Great Depression, yeah, which happened in the US. So this is your Great Depression. If you see here, 2000, this is basically your 2008 financial crisis. Yeah, this is your IT bust, right? So we had the IT.com bust in 2001. This is that particular recession. So as you can see, I'm showing you the whole history of about 100 years. So we took a history of about 100 years. We took a data for 100 years to really show you the picture and what is the outcome of this, okay? if you see the outcome, the average bull run or the average bear markets that you see, the average of 1.4 years. So the bear markets generally last for an average of about 1.4 years with an average loss of about 40%. Okay, and this is the average number. The bull markets have lasted, say, for an average of about 6.4 years, and the return that you can expect, the holding period gains, is about 200%. So this is based on the data that we have taken for the last 100 years. Okay, and I've shown you all the recessions in this particular slide. So guys, if my picture is not clear, there's probably an HD setting issue from your YouTube side. So just change the HD settings and the picture should be clear. Okay. Anyway, you don't have to see much. All you have to see is that the light blue segments are definitely bigger than the dark blue segments, which means the bull market definitely lasts for longer than your bearish markets. The average time that a bearish market lasts is for about 1.4 years. So now if you see, when you have the bearish markets, generally what happens is nowadays we don't see bearish markets even lasting for 1.4 years. Nowadays the recession doesn't last for that long. And why is it so? For a very simple reason, that you have the central bank and the governments who take very aggressive stands in terms of infusing liquidity into the system, right? And that helps in economic recovery. So if you look at the bearish markets during the dot-com burst, right, 2001, it was about 2.5 years. During 2008 global financial crisis, the bearish market was for a little more than 1 year. But if you look at now, COVID, right, the bearish market lasted hardly 3 to 4 months. So the times are changing, but the performance of different sectors in different market cycles, that remains the same, right? So which is what you have to understand. So now let's see what are some of the events that leads to the market crash, right? So this is visible to all of you. So generally, if you see, you will have different events because of which the market crash happens. So first one is oil shock. So you will have, if the crude oil prices are going up, for example, that is one of the reasons why markets would go down or economy would slow down. Financial crisis. So in the financial crisis segment, we have the Great Depression of the 1929, which we are not going to talk about in detail because that was way back. But we are going to talk about the dot-com bubble burst of 2001, and we're going to talk about the financial market meltdown of 2008. Then because of the pandemics, the markets would crash. So we had the Spanish flu last 100 years back, Asian flu, Hong Kong flu, and now, of course, COVID, right? And then because of a war. Yeah, so in this particular segment, when I'm going to be talking about market crash, we're going to talk about the dot-com bubble burst. We're going to talk about COVID. We're going to talk about the financial market, financial recession of 2008. Okay. And I'll talk a little bit about the Iran-Kuwait war because I want all of you to understand the correlation between crude oil and GDP. Yeah. So let's start off by understanding about crude oil prices. So this is a very interesting thing that all of you should understand, guys. I'm saying again that if you think that the image is not clear, the presentation is not clear, it's probably an issue with your HD settings. I would request you to please change your HD settings and it will be clear. Okay. So let's see what happened in the crude oil space. So oil shock, what India saw in 1991 was the Indian economy meltdown because of the crude oil prices going up. And that happened because of the Iran-Kuwait war. Yeah. Now, crude oil price at that particular point in time went up from $17 per barrel to about $36 per barrel. Okay. And subsequently, what happened was Fed, which is the Federal Reserve, also increased the interest rates. So now what happens is when the interest rate increases, the liquidity in the system goes down, right? Our inflation, the Indian inflation peaked at 17%. So this was the impact on India, where the Indian inflation peaked at 17% in that 1 year. Our GDP growth rate, it fell to 1.1% from say about 5.5% in the 1990s. In 1991, it was 1.1%. Our forex reserve was just about $1.1 billion, which is a forex reserve that would last for only about a few weeks for a country like India. So imagine that we only had a few weeks worth of forex reserve at that particular point in time because of the crude oil price going up. Yeah. So what Indian government did to actually get more foreign currency, we had physically airlifted 50 tons of gold to the Bank of England. So 50 tons of gold was airlifted from India to the Bank of England to get more foreign currency at that particular point in time. This is 1991. But what came out of it? What was the outcome of it? Opening up of the Indian economy. So the license Raj that we talk about, that was gone at this particular point in time, all thanks to the crude oil price. And this was the time when Indian economy opened up to the foreign players. This was the time when India allowed foreign companies to enter the Indian markets. Yeah. So if you see, a similar trend happened in 2011-12. 2011-12 was again a time when we saw crude oil price rising drastically, and that led to an increase in inflation and reduction in the forex reserve, yeah, the foreign reserve. And that again, there was a market correction in 2011 as well. So, which is why crude oil plays a very important role in the inflation, in GDP, and how the economy pretty much works, because there's so much dependency that countries have on crude oil. So, for example, a very big import for India is crude oil. Yeah. So, which means a lot of our foreign currency goes in getting crude oil. And if the crude oil price increases, then obviously our forex reduces, right? The foreign reserve reduces. So, which is why, like I always say, crude oil is something that we should watch out for. Now, next, what I'm going to talk about is basically the financial crisis. Yeah. And so, what are the different financial crises that we have experienced? We're going to start with the dot-com bubble burst, which happened in 2001. I don't know how many of you at that point were working or were a part of the workforce. But 2001 was a very, very interesting time. This was a time, so I'll give you a little background about what happened and why the dot-com bubble burst happened. Yeah. So, in the mid 90s, yeah, so from 94, 95 onwards, there was an anticipation in terms of, explosion in the number of internet users. I don't know how many of you remember this. I was in school at that time, and we had just started using internet, right? We used to have that dial-up connection at home. If you guys remember that, just tell me, right? We used to have this dial-up connection at home, which used to be connected to our phone lines, our landlines. Yes, and that was the time when internet was just picking up. Yeah, and there was such a big so much talk about the internet. There was a huge anticipation in terms of the number of users who are going to get added in the internet and the telecom space. And because of that, we had huge number of investments that started flowing in towards tech companies. So towards tech companies, there was a huge number of investments that came in. And what was the outcome of those? So we have a lot of products off the boom at that time. So we have companies like Amazon, Apple, Adobe, Oracle. These are all your products of the dot-com boom of the 90s. Yeah. And of course, these were also the companies that eventually survived the bubble burst in 2001. So I'll tell you what happened exactly then. So at the same time, what US did, they lowered the interest rates. Yeah. So whenever a country lowers the interest rate, it infuses liquidity into the system, right? Because now you can borrow at a lower rate, and the capital gains tax also was lowered. Now this resulted in easy availability of capital at lower rate of interest, right? A very logical thing. Most tech companies, okay, they were chasing revenue rather than profitability. So in the mid 90s, the companies that came in, right, they were the ones that were chasing revenue. They were not chasing profitability, and most of them were operating at net operating loss. Okay, the focus was obviously on advertising, on promotions, and all of that. I'm sure it's like a deja vu for all of us, right? I'm sure you get the point. So, what did all this eventually result into? So, what happened because of all this? Yeah. So, let me just show you what happened. So, as you can see, we had, Nasdaq, which is a tech index. So, Nasdaq index for the technology companies between 95 and 2000 had increased fourfold. So, Nasdaq had increased between 95 and 2000 fourfold. The PE of Nasdaq, by the way, was close to 200. So, just imagine the PE of Nasdaq was close to 200 at that particular point in time. The euphoria was just so much in the year 1999 that Nasdaq index gave 86% returns, okay, versus S&P 500, which gave 20% return in that 1 year. So imagine Nasdaq gave 86% return in that particular era. That was the kind of that was the kind of euphoria that people had around technology companies, because they were just booming at that particular point in time. So then the point is, if everything was going so well, yeah, I mean, if the companies are doing well, there's so much liquidity in the system, then what led to the crash? Then what happened? Why did this dot-com bubble burst in 2001, right? So I'll tell you what happened. So of course, I'm sure a lot of you remember the Y2K problem, right? So we had the year 2000, which was called, so because it was a millennium change, so there was something called as the Y2K problem, and I would request all of you to go back and read about it. It's pretty interesting for especially the younger ones who are not aware of it. Y2K was, anticipated to be a big problem from a computer internet users' point of view. Okay, and that got resolved in Feb 2000. So what happened was when Y2K was no longer a problem once the new millennium started, then US Fed indicated that they would start increasing the interest rate. So now there's nothing to worry about, and let's start increasing the interest rate. And what this led to was higher cost of funds, right? Now, because obviously everything has become expensive. This was also the time when Japan was entering into recession once again. Okay, so this was also the time when Japan was entering into recession. And we had, so obviously when Japan is entering into recession, we had a global sell off at that particular point in time. Most of the tech firms, because of higher cash burn rate. So, like I said, they were only chasing revenue, they were not chasing profitability. So, because of this higher, cash burn rate, they were running out of cash. And that led to bankruptcy of a lot of tech firms. So, when you run out of cash, you're going to, it leads to bankruptcy. And interest rates started going up. And I think the biggest impact, because the dot-com burst, the biggest impact was the 9/11 attack. Yeah, all of you know about the 9/11 attack. I don't think I need to talk about it. But 9/11 was a big blow to the global economies. By the end of 2002, by the way, what had happened, so let me just switch to the slide. So by the end of 2002, US equity markets had lost $5 trillion. So US equity markets had lost $5 trillion. To give you an idea what $5 trillion is, today India's GDP is less than $3 trillion. So today's India's GDP is less than $3 trillion. And I'm not even talking about today, by the way. This was 2001, where US equity markets had lost $5 trillion. So that's the kind of, that's this thing I'm talking about. NASDAQ had dropped 78% from its peak. So when NASDAQ was from its peak, it dropped 78% because of and this was at this time, the dot-com bubble burst. So then the question is, what happened to the Indian economy? Yeah. What happened? What was the kind of impact that it had on the Indian economy? So let me just, I'm guessing it is visible to all of you. I'm just going to anyway speak about this chart for all of you to understand. In mid 99, so from mid 99 to September 2001, Sensex went down by 48%. Yeah, Sensex went down by 48%. And the sector that corrected the most was obviously the technology sector. Yeah, technology sector dropped by 86% from its peak. So if all of you can see the screen, let me just maximize it for you. Yeah, so I'm guessing this is better. Technology sector, that's here, it dropped by 86% at that particular point in time, from mid 99 to September 2001. There were a lot of these there were some mutual fund companies that had launched the tech sectoral funds, so sectoral funds specializing in IT. And the NAV went down from 10 rupees to 1.8 rupees. So just imagine the kind of losses people would have borne. And along with this, of course, you saw consumer durables which went down. We saw capital goods that went down. We had auto that went down. So basically, all the capital intensive sectors, along with technology, IT, of course, because this was the tech burst, the main recession happened because of technology companies. But we had the capital intensive sectors, likes of consumer durables, auto, capital goods, that actually corrected the most at that particular point in time. Then what happened after recovery, right? So now what happened after recovery? The tech stocks came back. So tech stocks came back by 117%. But a lot of people said that this is great. So as you can see here, this is 117% from negative 87%. But I'll tell you what that means. It basically means, had you invested 100 rupees and it corrected by 86%, which means that your 100 rupees would have become 14 rupees. And now, if it has gone up by 117%, it effectively means that your 14 rupees went up to 31. So there's still a huge loss that you are bearing. For you to recover that 100 rupees back, ideally the growth should have been a little more than 6 times. So if you just see this, right, technology, IT sector fell to 14 rupees if you had invested 100 rupees, and when it corrected, it came back to 31. Similarly, your FMCG went down. If you had invested 100 rupees, it became 63, and it came back to 82. Similarly, consumer durables from 28 came back to 86, healthcare 55 to 119, and so on. So what I'm trying to tell you, by talking about this table is that whenever you see markets crashing, you see markets going down, you see recessions, slowdowns, those are the times when you will have your capital intensive sectors which are going to correct the most. When and you have your defensive sectors which will actually do well. So we're going to talk in detail as we progress further, because now if all of you understood what happened during the dot-com bubble burst, I'm going to quickly talk about the financial crisis, right, of 2008. Now I'm sure 2008 financial crisis is probably something a lot of you, a lot of us would have memory of. A lot of us would have experienced firsthand, or at least we would have seen it, heard about it. Someone in our family friend circle would have experienced it, right? Because this is one of the most recent financial crises that we have experienced before COVID. So now what happened in the global financial crisis? So, I mean, leaving all the technicalities aside, the genesis of this recession was really just the US housing market bubble. And, they created these mortgage backed securities, we call them MBS, using subprime loans, right? So that pretty much led to the fall of the economy in general. Yeah. So 2008 financial crisis saw the fallout of some of the biggest players, likes of Lehman Brothers and many other entities who eventually received bailout packages from central banks. Yeah. So we're going to talk about 2020 as well, Vikal. You just have to wait. I'm going in the chronological order. Yeah. So, the subprime mortgage-backed securities, securitization of assets, and creation of new investment options like, your CDOs, collateralized debt obligations, they literally brought the entire financial system down to its knees. You don't need to know the technicalities. I'm going to show you how the markets reacted and what happened. So, between 2007 and 2008, another thing that happened, okay, the challenge is everything comes together. Between 2008 and 2009, another thing that happened was the crude oil price went up from 50 rupees per barrel to 147 rupees per barrel. Now, that was another big hit. And this, added to the problem which was already there. So, as per the Bureau of, Economic Analysis, US economy contracted by 2.3, 2.1, 2.1, and 8.4% respectively from Q1 of 2008, which means 4 consecutive quarters where the US economy contracted in 2008. 4 consecutive quarters, that is pretty big, because the definition of recession says that negative GDP growth in 2 consecutive quarters. Okay, so this was obviously a big hit. At this particular point in time, in US, the home prices went down by 30%. S&P 500 index fell by 57%. The net worth of households and non-profit organizations, it fell from $69 trillion to $55 trillion. Okay, so increase in the crude oil prices that I was telling you about, it reduction. And so what happened was, because of the crude oil price going up, because of the markets not doing so well, the FII inflow. What is the FII inflow? That's basically the foreign investments coming in. So the FII inflow really went down drastically. Okay. So what happened was that the FI inflow went down from $20.32 billion in 2007 to $15.2 billion in 2008. And if we just look at the Indian economy, of course, there's a dependency on foreign investments, right? So in the year 2008, Sensex fell by 68%. Yeah. So Sensex alone fell by 68% during the 2008 financial crisis. And unlike other global economies, we were not in recession, we were just in a slowdown. So Indian economy as such was not in a recession, it was just in a slowdown. So if you look at the GDP growth rate, so as you can see the numbers, GDP growth rate, it went from 9% in 2007-8 to about 6.7% in 2008-9. Just for all of you to understand, ideally GDP should always be a positive number compared to the previous number. If the GDP has gone down compared to the previous year, then it means that the economy is slowing down. So ideally, the GDP should always be a positive number compared to the previous year. That is how it should be. So here from 9%, it went down to 6.7%, which is not very nice, right? And at this particular point in time, if I show you the chart, again, as you can see, and let me just maximize it for all of you. Again, as you can see, the consumer durables fell the most. So we had consumer. So a recession, again, the capital intensive sectors are going to not do so well. So we had consumer durables that went down 74%, we had metals 78%, and then we had auto 58%, finance, obviously it was a financial crisis, so financial sector went down 61%, and so on. But if you look at FMCG, for example, FMCG only went down by 16%. It gave negative returns, but it went down only by 16% as compared to capital intensive sectors like your consumer durables and so on, right? So, and healthcare 34%. So all these are called your defensive sectors. Okay, your FMCG, healthcare, these are your defensive sectors. So when economy is going down, it is these sectors that tend to perform. Okay. So this is why what I'm trying to tell you is that understanding this becomes quite important for all of us. So now we're going to talk about okay. So yeah, so this was basically how it recovered, right? So this was IT. So FMCG went down by 16%, but it came up by 44%. Yeah. Consumer durables went down by 74%, came up by 111%, and so on. Metal had the, it did the best in terms of, coming up from say negative 78% to 296%, and so on. This is between 2008 and 2009. Now we're going to talk about the pandemic. And honestly, I don't think I need to talk in detail about the pandemic because we just experienced it. We are still in the middle. I won't say in the middle of it. I hope we are in the fag end of it. But the point is, about the pandemic, a lot of people already know. But what I'm going to do for all of you is I'm going to compare this pandemic with the Spanish flu. Uh, Obviously, none of us experienced the Spanish flu, but I don't know how many of you have read about it, and I don't know how many of you have watched videos on it or know about it, read articles on it. Spanish flu was basically one of the biggest flu of the last century, right? So one of the biggest pandemics of the last century was the Spanish flu, which was exactly 100 years back. Yeah, COVID was 2019-20. Spanish flu was again 1918, 1920. So I'm just going to do this very quick comparison, nothing in detail because it's 100-year-old data, may not be relevant today. But of course, this was one of the biggest pandemics. And of course, the death rate was much higher, all thanks to the lack of medical infrastructure at that point in time. I mean, today we are at an era where medical infrastructure is very advanced compared to how it used to be 100 years back. So, I don't know how many of you know how it got the name. Do any of you know how it got the name Spanish flu, by the way? Just tell me if you guys know how it got the name Spanish flu by any chance. Anyone knows about it? How did the Spanish flu get the name Spanish flu? Did it originate in Spain? What happened? Does anyone know that? No? Okay, so let me tell you what happened in the Spanish flu and why is it called the Spanish flu. It is called the Spanish flu because Spain was the only country that allowed freedom of press. So Spain was the only country that allowed freedom of press in reporting the effects of the flu. Other countries did not report the cases, okay? And Spanish flu spread very rapidly across the globe for a very simple reason. It did not start in Spain. Spain was the only country that reported that gave the freedom to the press to report the numbers, okay? And it spread very rapidly. How did it spread so rapidly? Considering nowadays, of course, we have the whole world is global. People are traveling from here to there. So, of course, it's very easy for a pandemic to spread. But in those days, it wasn't like this. But you know why the pandemic spread like crazy across the globe? Because the World War One had just ended. So the World War One had ended in November 1918, and the Spanish flu started in about Jan-Feb 1919. So the World War One had just ended, and we had all the soldiers who were going back to their home countries. And when the soldiers were going back to their home countries, there was so much, migration, relocation happening at that particular point in time that we actually had the Spanish flu that spread like crazy across the globe. Okay, of course, India was one of the affected companies as well. But what you have to understand is we don't have numbers for that particular flu, so nobody knows what were the total deaths worldwide. But the anticipation it was anywhere between 17 to 100 million people. Okay, but nobody has the exact number, and 17 to 100 million is a big range, so you never know, right? At that particular point in time, 1.8 billion was the world's population. So even in India, of course, in India it was called the Bombay influenza, and India was one of the biggest, worst affected countries of the Spanish flu. Um, if I just show you a very interesting correlation, you will be able to relate to it. Okay, if you just look at this, these are the waves of Spanish flu. So as you can see, the Spanish flu also had three waves. COVID also had three waves. Wave 1, 2, and 3. Wave 1 was 2020 March, April. Wave 2 was last year April, May, and wave 3 that we just experienced about 1 or 2 months back. Even the Spanish flu had the exact 3 waves, and the severity was also the same. Wave one was pretty mild. The fear was much higher, but in terms of the intensity, it was pretty mild. Wave two was the maximum. We had maximum number of cases, maximum death rates in the COVID wave two, and the same case was the Spanish flu as well. And wave three was in between somewhere, and that's exactly what we experienced during COVID as well. So there's such a big correlation. Honestly, I thought that maybe talking about Spanish flu may not be very relevant, but I just thought it would be so interesting to show you this. So that is why I'm showing you this. Okay. So if I go back to what happened during COVID, right? So if impact of COVID and what happened, see, I'm not going to talk in much detail about COVID because come to look at it, all of us know about COVID. But what we need to understand is that COVID was so severe that 90% of the world economies were in recession. Okay. So just to give you a background, during the 2008 financial crisis, 60% of the world economies were in recession during the 2008 financial crisis. During COVID, 90% of the world economies were in financial crisis. And that is, the severity of COVID in terms of the impact that it had on the economies. In India, in March 2020, the markets fell by close to 40%. So that was how much the index fell for us. Okay. So now that we've spoken about the different market crashes, we spoke about the oil crash 1991. We spoke about the tech bubble burst. We spoke about 2008 financial crisis. We spoke a little bit about COVID. Let's look at what are the different actions that government takes, right? So what happens? So whenever there's a recession, what happens? What does the government do to bring in that economic recovery? Yeah. So there are different measures which are taken. The measures which are taken by the government are called fiscal policy, and the measures which are taken by the central bank, or for in our case RBI, those are called monetary policy, right? So I'm just going to give you a quick background about fiscal policy and monetary policy. So, like I was saying, fiscal policy is nothing but the government managing its income and expenses. Yeah. So during an economic down cycle, so whenever there's a recession happening or there's a market crash happening, what is going to happen? The market would crash beforehand itself. The market is not going to go wait for the GDP to go down. It is going to crash in anticipation that the GDP is going to go down. So because the economy is in trouble, now that's the time when income for the country goes down, right? Because the economy is not doing so well. It's not been able to collect so much taxes. So the income is going to go down for sure. Yes. But at the same time, what the government does is they want to support the economy. So they want to infuse more money into the market, right? So they will have these direct benefit plans, loan waivers, all of that. So they're infusing a lot of money into the market. And that is called expansionary fiscal policy. So expansionary fiscal policy is when the government is already in trouble, but it's still infusing liquidity into the market through all these different, policies that it comes up with. So that is what the government has been doing since 2020, even now. So during our, the COVID crisis, the government has been putting in liquidity, and even in the current budget, it is the same. So we are still going to infuse liquidity into the system even this particular year. Okay. Other than government spending, what markets, they also get a positive impact because of the global government spending, right? So globally, say US is also spending money because of the quantum of the spread. You would have globally the markets doing well. Then if you look at what is monetary policy, so when we look at monetary policy, is nothing but the central banks of a country bringing down the interest rate. That's one measure that they do. And second is quantitative easing. I've spoken in detail about quantitative easing as well in my previous sessions. So what is, when they bring down the interest rate, what happens is the loan rates go down, which eventually supports the businesses, right? Now businesses can borrow loans at a cheaper rate. Their current outflow of loans also goes down because the interest rates are down. It's simple, right? Say if you want to buy a house and if the home loan is available at 6%, you'll be happy, right? You'll be like, okay, the home loans are cheaper. Let me take a house right now. So you just get lured into taking loans. So it overall leads to an increase in consumption every time the interest rates are on the lower side. Okay. So now what is quantitative easing? Like I said, so quantitative easing is nothing but the government or the central bank, buying the bonds from the market, right? And essentially what they're doing is they're infusing liquidity by doing that. So now the moment liquidity increases, interest rates go down, like I said, it just brings up the whole system and it helps in economic recovery. So across all recessions, you look at any recession, any market crash, any slowdown that has happened, these are the measures that are taken. Your government will infuse liquidity through different policies. They'll give loan waivers, they'll give direct benefit plans and so on. and your reserve bank or the central bank of a country would basically cut the interest rate and buy bonds in the form of quantitative easing. So when we look at during the years when GDP growth is stable, right? So when we look at those years where GDP growth is pretty stable, is not going down, that's the time when the markets have done reasonably well. Obviously, if GDP is doing well, the markets are going to do well. Those are the years when you will have sectors like your consumer durables, like your basic materials that will stand out. And during the years when the markets are going down, so during the bearish phase, you will have your defensive sectors like your FMCG, like your healthcare, sometimes IT to some extent. They are the ones that will do well. Okay. So just to show you this, just a minute. Yeah. So here, we were talking about quantitative easing. Every time quantitative easing is announced, you will see markets going up. Then again, when quantitative easing is announced, markets go up. Quantitative easing is announced, markets go up. So there's a direct correlation. Every time quantitative easing is done, you'll have the markets rallying. Okay. Then we were talking about, of course, support from RBI as well. Like I said, so they bring down the interest rates for sure. And once the interest rates are down, that obviously helps the economy. So what I want all of you also to understand is that when it comes to the global interest rates, that also obviously helps. But now, what are the other factors that impact the market, right? So apart from the fact that, um, of course, if there's a recession because of a particular reason that we've spoken about, what are some of the other parameters? So we were talking about crude oil, right? Crude oil and inflation have this negative correlation. So if you just look at the 2012 data from Jan to December, every time crude oil price has gone up, you will see the markets going down. So look at this. When the crude oil price is down, Sensex is up. So your orange line is the market, which is Sensex I've shown, and the blue line is your crude oil price. Here the crude oil price has gone up, Sensex has gone down. Right? So there's this very clear direct negative correlation between crude oil prices and inflation. Similarly, if you see 2013 data where the crude oil prices were again going up, see here, when the crude oil prices go down, your markets, when the crude oil prices go up, your markets go down, right? So there's this super clear correlation, negative correlation between these two parameters. So crude oil, like I always say, is something that we should keep in mind, or we should look at while we are looking at, how the economy is going to do. Okay. So, and of course, GDP has a direct correlation to crude oil, right? If the prices are down, if the crude oil price is down, that will help in economic recovery, because Sensex is going up, markets are going up. It basically means the GDP is going up. Yeah. So now just to connect all these dots, so we've spoken so much about these different parameters, different market crashes, what happened in each of them, by how much the markets fell, what were the sectors. So I'm just going to put everything together and explain what is it that can be done and how you should approach this particular problem. Okay. So based on the learnings from the history, we can establish certain points, right? Based on everything that we've learned about history, what are the points that we can establish? Economy goes through its cycles. There's no denying that, right? There are different cycles, and economy is going to go through those cycles, and you as an investor have to understand which cycle we are in. At every economic slowdown or a recession phase, markets tend to react earlier and then they start going down. Okay. So markets will always react before a particular event has already happened, because markets are always working in anticipation. Defensive sectors, likes of your, FMCG or your healthcare, these are the sectors which are going to do well. So if you just look at this chart that I'm showing you, this is a GDP growth rate in 2008, and this is GDP in 2011. It is on the lower side, by the way. Compared to the previous years, the GDP is on the lower number. I couldn't show you everything, and that is why I'm just showing you these 2 years. Sensex gave negative 52% return in that 2008 year, and in 2011, negative 24%. So if you see FMCG, healthcare, they were the top 3 sectors. FMCG, healthcare, and telecom. And these are the bottom 3, 16. This is the rank of the sectors. So your consumer durables, metal, capital goods, reality, all these sectors are your lower sectors, which means sectors that didn't do so well. So I'm just trying to explain to you that when the markets are going down, or when the GDP growth rate is on the lower side, you will have certain sectors like your defensive sectors which will do well, and you will have your capital intensive sectors which will not do well. Similarly, when we're looking at from say a large cap, mid cap, small cap point of view, as you can see in 2008, for example, so these are 2008, 11, and 2018 when Sensex obviously didn't do well, you have this is your large cap. The SE 500 is your large cap. Mid caps, look at the kind of correction mid caps experience and look at the kind of correction small caps experience, right? So what I'm trying to say is that when you are looking at different market capitalization, it is very important for us to understand that at times like these we should stay away from penny stocks. If you haven't done enough groundwork and if you don't have good understanding about the fundamentals of a company, then you should stay away from penny stocks. Now, so another question for all of us to understand is that what are these high frequency indicators? Okay, so how does the market know that GDP is going to go down? Yeah, so if market is reacting before, if the market is already reacting before a market crash or before a particular event has happened, then how does the market know that GDP is going to be on the lower side? So there's certain high frequency indicators that you could look at. So things like your auto sales, power generation supply, tractor sales, railway freight traffic. So how much the railway traffic, fuel consumption, cement production, tax collection, and from the global point of view, the Fed policy rates, and so on. All these factors or all these indicators give you a clear picture in terms of where the economy is expected to head. And when you have that picture, when you look at all these aspects or all these parameters, if you feel that this is where the economy is going to head, the market is going to take all these into consideration and react before all these things happen. Okay. So these are also called hyper indicators. So now, if the economy is in the recovery phase or it's in the growth phase, then what happens, right? So if you let me just expand this for you again. So if the market is in the growth phase, then what is going to happen is that once the recovery path is set, you will have other sectors that will take over. So, for example, automobile, banking, and subsequently consumer durables, basic materials, metals. These are the sectors that will take over. So, if you look at these years, say for likes of 2009, 10, 13, 14, which were the good years for Sensex, where the GDP growth rate was good, you would see that these are the sectors that are doing well, right? Your metal, consumer durables, auto, healthcare, and so on. And which are the sectors that are not doing so well would be your utilities, FMCG, power, and so on. Yeah. So the trend is very standard, right? So what I'm trying to say is that when a market crash happens, you have certain sectors performing. When a market recovery is happening, you have certain sectors performing. And similarly, in the economic recovery and growth phase, you'll have your small caps that will do well, your mid caps that will do well, and large caps at that particular point in time will be on the lower side. Okay. So when we are in the recovery phase, it's the large caps which will be on the lower side, and your small caps and mid caps would tend to perform at that particular point in time. Okay. So I do believe that what happened in 2021 was actually a pretty classic example. So to conclude, there's this just one minute, yeah. So to conclude, there's just this very interesting saying that by Hero Honda, fill it, shut it, forget it. So I do believe that every time equities are meant for long-term assets, and we understand that. But while holding direct equities, while holding stock portfolio, it requires constant monitoring, right? And that is portfolio rebalancing is something that we should be looking at, and that would help you in generating those extra returns from the portfolio. Yeah. So yeah, so I do hope you guys have understood what I was trying to say. I do believe that every time a market crash happens, we should be able to look at market crash in a positive way and look at making our investment strategy match that particular market scenario. Yeah. So with that, I would like to end my session. I'm going to take questions now. So if you have any questions, please do let me know, and I'm going to answer them for you. Okay. Sajid says mutual fund is very risky. Sajid, it depends on you as an investor. If you're comparing mutual funds, and in mutual funds, if you're looking at equity mutual funds, for example, and you're comparing that with stocks, then again, mutual funds tend to be slightly lower in terms of risk compared to stocks because you have a fund manager who's managing your portfolio for you, and at the same time, you're investing in a combination of multiple stocks, so it's on the lower side. But honestly, it depends on how much you understand about that particular investment. I would say that we've done a lot of masterclass on mutual funds. Feel free to go back and refer to them and get a better understanding in terms of how mutual funds work if you already don't have so. Okay. Brijmohan is asking, market is very volatile. Should I stop my SIPs? Rizwan, I'm just guessing that if you invested for the long term, then why should you worry about markets very volatile? This is the time where you should actually be investing a little more, right? Because the market's on the lower side, so you'll get more units. I do believe that every market correction is a good opportunity for equity investors to put in the money instead of taking out the money. Yes, because now you will get the same thing at a cheaper rate. So if you're looking at buying a house, for example, when would you buy a house? When the house price is high, or when it's on the lower side? Obviously when it's on the lower side, right? So apply the same logic. I'm planning to invest in mutual funds this year. What type of mutual funds should I choose? So Manisha, when you're looking at investing in mutual funds, we ask you to follow some very simple strategies, right? If you're a first time investor, look at starting off with large caps, multi caps, flexi caps, mid caps. These are the kind of funds that you should start off with. And if you want to take, like, if you're looking at sectoral strategy, then you should follow what we've discussed in this particular session, right? Because to invest in a particular sector, timing becomes very, very important. So if you're looking at any sectoral funds, then timing should be that should be happening. Uh, okay, so if you guys are going to ask me some very futuristic questions, if World War III happens, I'm not going to answer them for you. I'm sorry about that. I would just say refer to my session that I've just done, right? Look at what has happened in the past. You would find a correlation with the future. Okay, let me take more questions. When markets are down, should we fear it or not? Why should you fear the markets, right? I mean, if you are a disciplined investor, if you're an investor who understands the markets, if you're an investor who believes that markets have the potential to give you good returns, you have no reason to fear the markets, because anything that goes down will come up, everything that's up will go down. That's the nature's law, and it is going to be there. Okay, so you just have to make sure that you are investing in the right products, right stocks, right mutual funds, and you're giving it sufficient time for it to grow. I believe in that mantra, and it has worked for me in the last 17, 18 years of investing. uh, Sectoral strategy, guys, if you ask me anything about sectoral funds, like I say, different sectors perform at different times. So based on that, you should be able to invest. Okay. Thank you so much for all the wonderful feedback from all of you. Okay. I'm going to take some more questions. I have some more time. So, okay. If you're going to ask me which stock to invest in, which mutual fund to invest in, I cannot answer that question for you guys. I'm so sorry. You know that we don't recommend, we don't advise any product. Uh, so is there a direct impact on Indian markets when USA increase or decrease interest rates? So absolutely there is. So there would be an impact, when the US makes any form of policy changes, when the interest rates go down or they go up, it definitely impacts the Indian markets. Today we are living in a world where the global economies do impact Indian economies for sure. Okay. Let me take some more questions, guys. So is it better to withdraw some fund from existing mutual fund before any recession? So, Mr. Ramshankar, see, I wouldn't say that you taking out your money or investing your money is dependent on that. What you should look at is, has your fund given you sufficient returns? Have you invested for a particular goal and you want to achieve that goal right now? I believe in a very simple strategy. If you've invested in equity funds, you are investing towards a specific financial goal, right? 2 to 3 years before that goal has to be achieved, you have to start switching funds or switching that your money from equity to debt. Okay, so ideally, if you are achieving your financial goal at this particular point in time, and say recession happens, ideally you should have already switched out your funds from equity to debt in the last 2 3 years, so that this recession doesn't have any impact or doesn't have a big impact on your current portfolio, because you'll have most of your money sitting in debt funds. So I would say that whether to withdraw or not really depends on whether you want to achieve a particular financial goal. And ideally, 2 to 3 years before you want to achieve the goal, you should be able to switch out from equity and move to debt. Uh, yes, okay. Again, Satish, you're asking me suggest 3 or 4 mutual funds. I cannot recommend. I'll tell you the categories. I believe that for an investor who's looking to invest in for long term, you look at your flexi caps, large caps, mid caps, maybe multi caps. But if you have a short term time horizon, then you could look at, say, small cap sectoral funds. But then again, timing is very important. And of course, I do think that to some extent, a small part of your portfolio, all of you can put in your passive funds, so index funds and the likes. Okay. So Okay, what are the other questions? How long will market correct? I don't think anyone knows that. I don't think even Warren Buffett knows for how long the markets are going to correct. I just believe that if you are following a particular investment strategy and if you think that works for you, then so be it. Yeah. Uh, okay, sure. So I think is it advisable more in since market is down, is it advisable to invest more in equity? I mean, yeah, of course, right? I mean, I believe that if the markets are in a good time to invest in equity, good time to enter the markets at this particular point in time. Don't you think so? So yeah, so thank you so much, everyone. And if you have any more questions, please feel free to mention it in the comments, and the Grow team will get back to you with the answers. And I do hope, I sincerely hope you guys had a good time listening to me today. And I hope there were some really solid takeaways that all of you had. I'm going to be doing the same thing in Hindi. For those of you who want to listen to me in Hindi, please feel free to join at 12:30. Yeah, so all the sessions, all the master classes that I've done are available on YouTube. You can just you can check out all the master class on YouTube. I hope you've subscribed to the Grow channel so you will get all the invites anyways. Thank you so much. Take care, guys, and I wish you a great weekend. Bye bye.